Hi, welcome to the Market Alert for Wednesday, the 26th of July 2017. So yesterday the Dow puts in a new all-time high in the pre-market session. We saw prices moving steadily all the way up to make the new high, which came in at 21,683, wasn't it? I think. Let me just remove this. It's just shot off the page. And do that again. There we go. 21,688 is where it came in at, and it was somewhere with 8s in it. Yeah, this high was made in the pre-market session, and then once the market opened, you can see prices trading down. And then, as ever, they want to bring the market back. So you see prices coming back there with the winning trade, and then towards the end of the session, there is also a quick 20 points to the downside, which I wasn't around at the time to actually do. And as I said in yesterday's morning market alert, I'm happy to gather the money in the first part of the session. You just never know how quiet it's going to be in the latter part. But on this occasion, the market did move down a bit. In the daily chart, well, you can see what is happening here. Let me just remove this one because I drew that on yesterday when the market had just made, or was about to make, the high. So let me put this one in here, and let's just rescale this a bit and bring it over. So what we got here is certainly a sideways market. You can see that without a doubt. So in order for the market to move higher now, it's got to break above this level and keep moving it to the upside. It's as simple as that. And to help it do that, what have we got out today? Let's have a look at the US more importantly. We start off with new home sales, crude oil inventories, and then of course we've got the main event of the day, which is going to be the FOMC minutes. They're going to be released at 7 p.m. There doesn't appear to be any surprises. The rates remaining unchanged at 1.25% there for the US interest rates. In the pound, a bit of a different story yesterday. The market very quiet in the first 3 quarters of the session. You can see there just sideways, and then all of a sudden we had a break to the upside. And the only problem with this is there was no momentum, absolutely zero momentum. See the market being filled here, prices trading sideways. You're exposed a lot on this one when the market, as I said in yesterday morning's alert, is likely to remain sideways because we're getting close to the recess in Parliament, not a lot making the news, so we could expect the market to remain sideways, and that's precisely what the market did. It came up and then it traded in this sideways range. Now each of these bars are 15 minutes, so it's not as if you've got a minute chart where you've got to make a hasty decision. And here you can see that the market is struggling. First 45 minutes here, you can see prices sideways. So what you want to do is in a situation like this, is you can move the stop up. Don't sit there waiting and waiting and waiting in the hope that it may return. You've got this support here that is broken as well eventually, so you can actually reduce the loss. If the market hasn't moved after 45 minutes, it's highly unlikely in the pound at this time of day that it is going to move anyway. So you can, move the stop up, tuck underneath and reduce, get out and stand aside, because again, the backdrop and fundamentals for this, as you look in the daily chart, you will see that prices are also sideways as well. Just bring that down to there. So the situation is we've got the market retracing. It traded up to the 76% retracement here, which you can see there at 130. We moved and marked that in on Monday. Market traded up to it and then failed to move any higher. And you can see the price bars are very narrow as well. I'd expect more of this to continue in the pound as we go through the summer holes as well. On the implied volatility front, we've got the implied down at 703, the same as we had on Friday. That'll be Friday. We're up to 717 on Monday. Tuesday 703, same as Fridays there. So again, just sideways to lower. Right, that's it for today really. There's just a couple of news items. Let me just grab these for you, show you what's going on in the background. An interesting couple of news items somewhere. Yeah, the death cross of central bank credibility. Well, I'm amazed that they still have any credibility anyway, but that's an interesting article there. With no expectations of a rate hike this week and traders rapidly giving up on the Fed's dream of a steadily higher rate trajectory, a funny thing happened in the markets. And this one is a very interesting one as well. Here we've got stocks scrambled to fourth largest stretch of dipless gains in 90 years. Even though the implied volatility is down in the lows, there's still no correction at the moment, and it's the longest stretch in 90 years. So again, this ties in with a situation where once it goes, it's going to go big style, because we've not seen anything for an awful long time. I think November was the last time we had an 800-point dip when Trump was elected, and since then the market's just moved higher, and it can't continue to do that forever, as the implied volatility points in that direction, that there is a correction coming, but no doubts through the summer they will hold this market on the highs and continue to make new all-time highs as well, unless something comes out of the blue with Russia and Trump and all that other stuff. So we'll just wait and see. Right, that'll do it for today. I'll report if something to bring your attention to, but also keep in mind that FOMC trading can be fairly strange as well. First part of the session tend to get either a lot of movement or nothing, so we'll take a view, see what happens in the pre-market session, and then of course the market will go quiet beforehand and then likely to be very quiet after as well. So anything to be gained or to be taken off the table will be in the first part of the session, in my opinion. That's the pattern we've had for the last couple of years. Right, that's it. As ever, thanks for watching. See you in the next one.